And I'm going to have a record, notes taken for us by the AI companion. All right, ladies and gentlemen. So then we're looking at advanced financial management, and I would want us to move slowly in a way that everybody will be very happy with our today's class. Today is a day where people should be happy and happy. Happy and happy. And I would want us to start with November 2020, question number 1B. November 2020, question number 1B, Professor Edward Altman's model under restructuring. So we are starting with November 2020, question number 1, boy. November 2020, question number 1, boy. November 2020, question number 1, boy. Question number 1, boy. So once in this case here you get this question, are you able to say yes? Like these, yes. Yes. Why for yes? Paul Joseph never disappoints. Already has this. Marianne has also gotten it. So Professor Edward Altman's model for prediction of bankruptcy is given as follows. So you can see they have given us, ladies and gentlemen, there. The Z-score. They've given us Z-score, which is 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 0.99x5. Where x1 to x5 are the financial ratios which, according to Professor Altman, have the discriminating power. So you can see x1, what it is. But you see those ratios, x1 to x5, nobody can ever give them to you directly. No matter how much these people love you. If they bring you this kind of a question this semester, they will not give you the formulas for getting x1 to x5. In that regard, it means that I must be able to remember some acronym. Is there somebody who is able to remember the Altman's acronym of WAREMAS? Are you able to remember the Altman's acronym of WAREMAS? Thank you very much, Paul. Thank you very much, Eljoy. WAREMAS. And then remember there are those ones which walk in twos, like couples, WO2s. In this case here, market value. Those are, they normally walk together, two of them. But these three, in this case here, they walk alone, single. So we start with WO. So WO, ladies and gentlemen, this stands for working capital. This stands for working capital. And then we have R, which stands for retained earnings. R stands for retained earnings. We have E standing for EBIT. We have, this comes like market value of shares, market value of ordinary shares, market value of ordinary shares. And then we have lastly S. S in this case here stands for what here? Sales. So remember that this will give me X1 ratio. This will give me X1 ratio, X2, X3, and then we have X4, and then lastly we have X what here? We have X5. Thank you very much, Joy. We have X5. But you see, we want to make them ratios. So for us to make them ratios, we must come here and divide everything by tata. It's very good to be a man. Very good to be a man. Why did you give birth to a young kid there? There's a mother who really struggled with this kid. Really struggled. 1.5 years down the line, the very first word that this kid will pronounce when they start speaking is not mama, it is tata for baba. In most languages, tata stands for baba. So in this case, here, you divide by ta, except X4, which you divide by what here, somebody, which you divide by TL. Except X4, which you divide by TL, where TO stands for total assets. Ta stands for total assets. So is there somebody who is able to see the total assets from the balance sheet given? Let's first of all square that out. Is there somebody who is able to see the total assets? Total assets from the balance sheet. There is a balance sheet called statement of financial position there. Total assets. How much are you able to see there? 400,000. Total assets, they are 400,000. Thank you so much. How about total liabilities? Are you able to see the total liabilities, my good students? Are you able to see my total liabilities? Go to this balance sheet. The other side of the coin, just give me one value. One value. One value. Give me one value. Give me one value. Did you remember to include the preference? Remember, preference capital is always taken to be what here? Preference capital is normally taken to be part of liabilities. Preferential capital is normally taken to be part of what here? Part of liability. So think round, think widely. Think widely there, think widely there. Give me the total liabilities. Give me the total liabilities. I would really be happy to see total liabilities from all of you. From all of you. If you're able to give me the total liabilities, then I will be very happy. Waiting. What in this case here, are you guys able to see as your total liabilities? Now they're not talking to me. They're not talking to me. Now they're not talking to me. So how much do we have there? I want them to argue out. How much do we have there? How much do we have there? So they're saying, ladies and gentlemen, it is 140K. But now here you have to be very, very careful. You have to be very, very careful. Remember, this examiner here, you have to be very careful, especially when he gives you the formula. When he gives you a formula there, you must be very, very careful. Here, what they want us to give them, ladies and gentlemen, look at the denominator. The denominator of this. What do they have there for the denominator? You have to be very, 140 is correct. When we are looking at this from the total liabilities, we normally take the current liabilities plus non-current liabilities plus preference share capital. Allow me to write that very well here. But anytime they want us to give them total liabilities, anytime they want us to give them total liabilities, we normally take current liabilities plus non-current liabilities plus preference share capital. That is the formula. That is the formula. That is the total liability. But what of a situation where the examiner talks about debts, debt including preference share capital, including preference share capital. Can we take current liabilities as debt? Is current liabilities part of our debt? Are current liabilities part of our debt? You know, when they talk of debt, they're basically making reference to what here? Long-term debt. Long-term debt. Long-term debt that you have gone to borrow or you have issued bonds there. You have issued bonds there. So if you look at the formula they have given us, they have told us to use debt including preference share capital. Please look at there. They are talking about market value of equity shares over book value of debt. Book value of debt including preference share capital. So when they talk of debt, then they are talking of what here? Long-term debt, the bank loans, the bonds, the debentures. So like now here I can see the debt there long-term, it is 80,000. It is 80,000. That is the only debt that we have, plus our preference share capital. Our preference share capital happens to be what there? Somebody happens to be 40,000. Happens to be 40,000. So then this will end up giving me what figure? Somebody there? This will end up giving us 120,000. I agree with you. And we would have really used the 140,000 had they not given us a formula. In the formula, their formula for X4, they have specified that they want us to work with book debt, what we have borrowed. Book debt, book debt, the book debt, including what here? Preference share capital. Therefore, in this case here, I will not work with total liabilities here. here I'm working with, I would want you to change this as per the formula they have given me. They have given me a formula where this one is book debt plus what here somebody inclusive of preference share capital. So I've taken the book debt. There is only one debenture not given there, which is 80,000 plus 40,000. So giving me 120,000. So up to here, ladies and gentlemen, are we really together? Have you been able to book that 120,000 yourselves? Great. Then what I want us to work on one stuff here, on one ratio at a time. Let's start with X1 where they want us to get working capital. So is there somebody who knows the formula of working capital? Is there anybody who could be knowing the formula of working capital? Working capital is CA minus current liabilities. So anytime they want us to get to them, the working capital, we normally take current assets minus current liabilities. So are you able to see the current assets in this question, really? If you go to your asset section, the current assets there, the current, I can see them, they are 100,000. Current assets are 100,000. We divide this by, not divide but minus, the current liabilities. Are we able to see current liabilities there? Oh, yes. We can see current liabilities of 20,000. We can see current liabilities of 20,000. And then whatever we get here, we divide this by what here? We divide this by total assets. Where total assets, you guys have given me a figure of 400,000. You guys have given me a figure of 400,000. So is there somebody who can give me the X1 value? Is there anybody who can give me the X1 value? So according to Mary Ann, Elijoy has also joined this. Dennis, great. So in this case here, we are getting there 0.2. And I will be able to wrap that working. I would want to wrap that working. Once you guys are able to write that 0.2, once you've been able to see where we are getting 0.2 from, then I should be able to wrap my working here because I want to create space. So we are saying that this one is 0.2. This one is 0.2. This one is 0.2 like that. How about this second one? Can somebody give me the X2 value? Is there somebody who can give me this X2 value? Is there somebody who can give me the X2 value? X2 value, what do we have there? X2 value. Remember, it is retained earnings. Which retained earnings are we talking about? Not the income retained earnings, not the income statement retained earnings. Retained earnings given the income statement is a 1 year's retained earnings. For us here, we want the balance sheet retained earnings. The retained earnings in the balance sheet, which belongs to the owners here. If you look at the equity, capital, equity, you'll be able to see there retained profit. Retained profit. That is the same as retained earnings. So then I should take here 120,000. We divide this by still the total assets. And total assets here, you're right, they are 400,000. So is there somebody who is able to see that 0.3 that this range has got? Is there anybody who is able to see the 0.3? Great. Thank you so much. So this one, we are saying it will be 0.3. This one here will be 0.3. Now from there, we go to EBIT. EBIT, this is operating profit. EBIT is earnings before interest and taxes. That one, we shall get it from the income statement. If I go to my income statement for sure, I'll be able to see operating profit of 40,000. Are you able to see operating profit of 40,000? Yes, they've been able to see it. So then this one here will be 40,000. You divide this by total assets, which are 400,000. So what figure are we able to get there? 40,000 divided by total assets. So 0.1, you're right. So 0.1, you're right. 0.1, you're right. Now from there, we come to this market value of ordinary shares. Market value of ordinary shares. Market value of ordinary shares, I know this is the simplest thing ever on this earth. To get market value of ordinary shares. The person who taught me this told me, I mean, this is very easy. To get market value of ordinary shares is the easiest thing ever. How do we get market value of ordinary shares? You simply take the ordinary share capital, you divide by the per. And then whatever answer you get, you multiply this by the MPS, the current market price per share. So first of all, to get market value of ordinary shares, you must give us the number of ordinary shares. How do we get number of ordinary shares? you will simply take the ordinary share capital given the balance sheet. You divide that by par value. When you take OSC, you divide by par value, you get NOS, number of ordinary shares, and then how you multiply this with what here, the market price per share. Now, ladies and gentlemen, are you able to see the ordinary share capital in this question? In this question, are you able to see the ordinary share capital? Yeah, I can see there the ordinary share capital is 100,000. Is 100,000. I divide this by the par value is given there in brackets. It is 10. Par value is 10. And then I look for the market price per share, which is given down there before required. I can see somewhere there the last sentence. The firm's ordinary shares are currently trading at 15. They're currently trading at 15. So then can somebody in this case here give me this market value of ordinary shares? Can somebody give me the market value of ordinary shares? So market value of ordinary shares, ladies and gentlemen, we have here 150,000. And this one here we are dividing by, not total liabilities, don't get me wrong here. We are dividing this by the book value of debt, inclusive of preference share capital. That figure we got it somewhere. It was 120,000. 120,000. So is there somebody who can give me this question? Is there somebody who can give me this question? So this one here, Frida, is giving me 1.25. Frida is giving me 1.25. Frida is giving me 1.25. So then can you kindly do for me the last one, the sales divided by total assets? Is there somebody who can do for me the sales divided by total assets? Sales divided by total assets. So sales divided by sales amount, go to your income statement. In the income statement, ladies and gentlemen, I can see sales of 400,000. We divide this by total assets of 400,000. And that is why you are seeing somebody telling me that this one is uno or una, numero uno in Spanish. That is one. So then once I finish that, ladies and gentlemen, I will need to come and now plug in this excess on the Z equation. I need to come and plug in this excess on the Z equation. So the Z already have given us the Z equation. Even this semester, should they bring this question, they shall give you the Z equation. Don't struggle cramming it because they will give you the Z equation. So Z is 1.2x1 plus we have here 1.4x2 plus we have here 3.3x3 plus, ladies and gentlemen, we have here 0.6 what here 0.6x4 plus, ladies and gentlemen, we have 0.9999x5 like that. Now we have all the x values. We just need to come and substitute in the proper term. So 1.2x1, I can see it is 0.2. Plus 1.4x2, I can see x2 is 0.3. Plus 3.3x3, I can see x3 is 0.1. Plus 0.6 times x4, which will be 1.25. Plus, in this case here, I have 0.9999 times x5, and x5 I'm seeing is 1. So here you have to pray hard as you punch this so you don't get a wrong answer. I can see someone asking a very good question there. How much is the total liabilities? But we are getting, they're getting different answers, imagine. I don't want you to give me like 1, 1, 1, 1. I want you to get me the total Z value. Total Z value. Using your calculator, you should be able to give me the total Z value. Total Z value. So is there somebody who is able to get 2.739? 2.739. Is there somebody who is able to get 2.739? 2.739, which is very good. So before I explain how I got the total liabilities, then could you kindly go and draw the number line? And your examiner has given you, actually, this examiner was a very good examiner. He told you a score of 2.7 or more. A score of 2.7 or more indicates no signs of failure. and a z-score of 1.8 or less indicates that there are signs of failure. Signs of failure. So then can you kindly go and draw that on your number line? Remember our number line. Remember our number line. So, ladies and gentlemen, looks like this. Our number line looks like this. Our number line looks like this. This is how our number line looks like. So our number line looks like this. So we have here 0 to 1.8. Then we have 2.7. Then of course we have more there. Should our z-score fall here, be 1.8 and below, failed, bankrupt organization, 100% bankrupt, 100% bankrupt. Should it fall more than 1.8, but of course less than 2.7, in between here, we normally talk of 50% bankrupt, 50% bankrupt. Over here, it is a successful organization. Over there, it is a successful organization. So Stanley already has finished this because our Z that we computed Z of 2.739, which of course falls here. 2.7 or more is successful. 2.7 or more cannot be bankrupt. So in short, as this gentleman, all that Stanley is telling us is that alpha is what here is successful. Alpha is successful organization, 100% successful. Then now there is a question that students have asked me. Mwalimu, look at X4 very well. You see, X4 normally, what we normally do to get X4, we normally take market value of shares. Market value of shares divided by total liabilities. And normally what we do, we remember very well, total liabilities. To get total liabilities, we normally take the current liabilities plus non-current liabilities plus any preference share capital. Because remember, preference share capital owners, they normally get a fixed dividend. They normally get a fixed dividend. So if they're getting a fixed dividend, then that would mean automatically that, they're debt owners. They've given us debt. They have given us debt. They have given us debt. Those ninjas have given us debt. All right. So then if that is the case, I can see the current liabilities, they're 20 from the balance sheet. From the balance sheet, I can see the current liabilities there are 20. The current liabilities there are 20. And then you can see the non-current liabilities. The non-current liabilities are how much now? I think I've even lost the question. The non-current liabilities, if you look at non-current liabilities, those are the debentures. Debentures or bonds, long-term. So debentures or bonds, I can see straight away there that they are 80,000. They are 80,000. They are 80, and then preference share capital. I can see preference share capital, 12% preference share capital is 40. But you see, as examiners, so this one here automatically would have given me 140 as a total liability. But as examiners, we are trained and we know that we are at war with our students. That much we know. Nikirelax kidogo, utanipiga na mnayo utanimaliza. Na pia ukirelax kidogo, na minda kunyorosha. All right. So what we do, we keep on twisting. Like one of the ways of twisting this question is to come and give them the formula for X4. Tell them that X4, in this case here, it is equal to give them the formula. Market value of shares. Look at the formula given. Divided by what here, somebody? Divided by book value of debt. Book value of debt. Including what here, even if you're not told, that preference shares should be included, preference shares will always be taken as a debt instrument. So then what do you understand by the name book value of debt? You see, book value of debt, these are long-term debts. Long-term debts. Short-term debts, like this current liabilities coming out of our sales, then that one, will not be counting, coming out of purchases. These are short-term. Actually, we already have the money. It's all that, we want to preserve our liquidity. That's why we don't want to pay. So the book value, what is being booked as a debt is the long-term debt. These are current liabilities and this one here. That's why we took, in this case here, 80 plus 40, which gave us 120, like that. And I hope up to there, then we are okay now. I hope up to there, we are okay. On the number line. Number line has a problem. The number line should not have any problem. You know the number line, this, you cram this 1.8 and 2.7, you cram them. Anything less than 1.8. If, for example, you do your Z-score of your company, and then you get 0.5. 0.5, where is it? It's less than 1.8. It means that your company is bankrupt. That automatically means that your company's liquidity, you are insolvent. You can't manage to pay any of your liabilities. You're insolvent. But should you, in this case here, get your Z-score falling in between here, then you are 50% bankrupt, 50% successful. Any haukufi uko tu hapo. All right, 50-50. So 50% bankrupt, meaning that the company is 50% what year successful. But should you get your Z-score, like I remember this lady called Mary-Ann had given you guys an assignment to go and calculate the Z-score of your companies. And Mary-Ann was able to get her company's Z-score way up there, about 5. That must be a very serious organization. That must be a very serious organization. So I hope that is okay. It's about cramming, knowing that anything less than 1.8 is red. In between, I don't know the color to use. But more than 2.7, that is green. Very good company. Very good company. Very good company. Very good company. The number line, you will not be given number line. This is the first time they have given us a number line, madam. You must have seen many questions in the past paper. This is the first time they gave us that. The figures there. It is you, in this case here, to do what here? It is you, in this case here, to come and do what here? It is you to come and it is you to come here. 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 Yeah, you cram. I mean, these are very easy things. 1.8, 2.7, you cram like that. A good question is coming there. What of situations where you are given like tangible and intangible assets, especially goodwill? All right. So in this particular case, we are concerned, or rather, we leave out those goodwills and whatever. All right. This is a ninja who has read an ACCA book. So then what I'll do for you to be able to understand even what this lady is asking about, I'll have to get this ACCA question and then we do it. Where in this case, you're being told here, when you're getting total assets and you have those goodwills, you know, a company that is being evaluated for failure, bankruptcy, is a company that doesn't have goodwill in the first thing. So whatever goodwill that is there, that goodwill must be seriously impaired. So you're better off in this case here, leaving it out. So that is quite deep. Just like, for example, in the sales, if you're given things like sales returns, then we shall always work with what we call net sales. But to avoid confusing you, I would rather work with a question itself, and then we get to solve it for us to be able to get deeper and a broader understanding of the subject. All right. Now, ladies and gentlemen, from there, with your permission then, I would want us to do just 2 things here, very, very fast questions. And I would want us to look at May 2021, question number 3A. May 2021. Yeah, 1.8 and 2.7 are standard. Please, Sylvia, look at what Dennis is telling you here. Cram 2, they're standard. Cram 2 nani. Cram 2 saizi. Cram nani, we move on. 1.8 and then 2.7. So cram like that. It will be easier that way. I wanted to avoid that term, but I find it to be very relevant here in the situation given that we want to do very many questions. 1.8, 2.7. 1.8, 2.7. Now, ladies and gentlemen, in this question of May 2021, are we there? No. Before May 2021, we have part A. Discuss 4 reasons. Discuss 4 reasons for restructuring and reorganizing an organization. Why do you think in this case here do we go for business restructuring and reorganizations? Please give me an answer to part A of this question. Give me an answer to part A of this question. Why do you think in this case here do we need to be restructuring and reorganizing organizations? And today I'm going to give a very good present, ladies and gentlemen, to that student who is able to really give me very, very good answers. Today is a day to award great students here. Why do you think in this case here do we need? Discuss 4 reasons for restructuring and reorganizing an institution. Abracadabra, I want to start reading your reasons for restructuring and reorganizing institutions. I want to read yours first. Why do we have to restructure? Why do we need to restructure? They're giving me very good points there. Very good points there. Do we restructure to boost performance? To increase synergy? To avoid liquidation of the company? Very good ones. So then I will be able to give you my points, and then you compare those with yours, and then you tell me which one we take. So the first one, ladies and gentlemen, is to increase profitability of the firm. To increase profitability of the firm. So this firm has been making persistent losses. So now we want to turn things around. Then we'll need to restructure it. We change the capital structure, we change the organizational structure, then that way we'll be able to make it more profitable. Of course, if I don't have enough points, I can also ride on that to mention something to do with to increase a firm's liquidity. To increase a firm's liquidity. So remember, restructuring, reorganizing, at times you're doing what we call unbundling. You are selling, in this case, here some subsidiaries here and there, some shares here and there. You are basically trying to show up your liquidity position here to have a competitive edge or advantage. To have a competitive edge or advantage. Remember, when you are restructuring, at times, ladies and gentlemen, we keep on employing workers. You're bringing in workers. You get yourself having so many workers in a firm. So then when you come and do what you're restructuring and say, no, we're not downsizing, automatically, ladies and gentlemen, you'll be able to be left with the workers who are few, well motivated because of remunerations, and then automatically they will be able to give you a competitive advantage. Remember, ladies and gentlemen, restructuring is not only for firms that are in financial distress. Even profitable firms can restructure with an aim of having a competitive advantage over their competitors. Of course, in this case, such firms will strive to have a greater market share, reduce competition, or even strive to be unique in a way. We restructure at times, in this case, to be unique, to bring even, as somebody mentioned, their synergy, to bring synergy. So, for example, when NIC and CPA Bank came together, that's a form of restructuring. Mergers is a form of restructuring. All right. Now you can see, I want to believe that now, right now, in terms of asset base, they're bank number 3. So they're able to fight off. So we have here another reason that I'm not seeing you guys talk about is to minimize or avoid hostile takeover. To minimize or avoid hostile takeover. You see, like currently there are so many people who want to acquire Safaricom. So if Safaricom in this case here wants to avoid that kind of hostility where we have somebody coming from even America, from the European countries, those European countries, and then they start buying shares of Safaricom at the stock exchange without knowledge, we have those guys having over 50%, 50% plus 1. So the moment they take a controlling stake, then they have automatically taken up the company without your consent, if I may put it like that. So to avoid a hostile takeover, the restructuring can be very good. That is why you are seeing on the dailies that M-Pesa, in this case, they would want to expunge M-Pesa from Safaricom. They would want this to be 2 companies, To be 2 companies, So when they do that, it's called unbundling. All right. When they unbundle a company like that, then that is a form of restructuring. They'll be able to avoid any takeovers. They could be good takeovers or hostile. So to reduce debts to manageable levels. To reduce debts to manageable levels. Like KQ, the other time I told you they had a consortium of loans. A consortium of banks came together to give it what we call a syndicated loan. So when Kenya Airways could not manage to pay back those loans, they called these banks, told these banks, hey, we can't continue to pay you these loans. Please, instead of these loans, instead of us paying you back the money, you buy our ordinary shares. By doing that, they were able to reduce their debts to manageable levels. Now they are able to pay back the principal and whatever. We restructure, ladies and gentlemen, so that you can as well stabilize a company, so that investors will inject new capital. Like right now, Kenya is really underwater reconstruction. Kenya itself, because we are being put under so much pressures from our financials, all right? Do this, increase taxes, fire civil servants, all right? That's a form of restructuring. And the moment they're able to restructure like that, World Bank comes, gives them what year money. Ladies and gentlemen, we can also restructure because we want to be left with just our core business to enable the core business units here to be run effectively. So, of course, you guys had really all those points, and I like your energy. I like your energy so much. There's a question that we have discussed severally, but I would just want you to have it now in once and for all. May 2021, question number 3A. May 2021, question number 3A. May 2021, question number 3A. I can see 20 new messages. Yeah, they have so many points. Very good points. They take the best ones, and then, of course, if possible, we can forget some points. Even mine, if you feel that this point is a little bit weak, leave it. Then we continue. So now we are doing May 2021, May 2021, May 2021. May 2021. Have you gotten the question? May 2021. May 2021. Question number, May 2021. Question number 3A. So question number 3A, they want us to give them the meaning of the term unbundling. You see, like, I'm so sure even men who are here, do you know, like, for example, a bundle of unga, like a bale of unga, a bundle of unga has got how many packets of unga inside? How many packets of unga make that one bale? So when they're put together, we call that a bundle. When in this case here, we disintegrate them, when we break them up, you start in this case here, so you are unbundling. When you start in this case here, opening that thing, removing one unga here, giving to Aura, another unga giving to Joshua, you are unbundling. So the same happens whenever you have like a conglomerate, whenever you have like a huge institution, running big companies is not a walk in the park. If we have any person who is a CEO of a company, ladies and gentlemen, will tell you, running a big company is not easy. I'm running a very small company called RCM. And the RCM, of course, we have got other sister institutions there. All right. We have RCM Physical. We have RCM even welfare. Now we have RCM welfare. But I would want to make a promise that within 1 year, this RCM welfare will become one of the biggest circles. Right? So we have got many units within RCM. The units, initially I was I don't know whether I'm getting aged very fast. All right. Initially I could be like all over on WhatsApp. Nowadays I'm not all over on WhatsApp. So there are units in this case here that are able to even do in my absence. Fortunately, we have very good managers who are able to run them. But the point is, when you have a big institution, it becomes very hard to manage. So at times, unbundling, where you dispose some subsidiaries, you sell some assets of the company, you separate, in this case, your units within a company, becomes inevitable. It is this separation of business units from the parent that we call unbundling. You're separating them with an objective of selling them. So right there, unbundling. Or at least Hassan knows they are 12. They are 12 years. Hassan knows that they are 12. So right there, unbundling, and meaning of unbundling. So tell us there that unbundling is a strategy where subsidiaries stroke subsidiaries stroke units of a firm are separated from the parent company, in order to improve the performance of the existing company, or the newly formed units, So these unbundled units, ladies and gentlemen, in this case here, we could either keep them, or in this case here, we can sell them off. But the key thing, ladies and gentlemen, in this case here, we would want to have organizations that are small organizations that are run efficiently, whose even share price now will be able to increase. Firms in this case that will be felt in the market. All right. So unbundling. Once we hear of this unbundling, you are able to remember it is a split up of, in this case here, a big, huge firm into different units with a view of, running now smaller outfits efficiently, ensuring that now you are able to maximize each of those units' profitability, ensuring you're able to maximize the share price, ensuring that you are able even to, in the long run, why are you unbundling? You'll be able to sell some of them to raise liquidity for the group. You'll be able to sell some of them, in this case here, so that you can be left with the core business, All right. Then they wanted us, ladies and gentlemen, there, and this they have really repeated. I don't know why students don't understand this very well. If you look at Roman 2 of this question, they want us to give them forms of unbundling a firm. So here you discuss anything regarding what here, like how could it be unbundling, and then we sell what here, we sell the units. So you discuss everything. For example, if I'm the one here, these are the same as strategies of unbundling here. So for example, I would come and talk about sell-offs. So sell-offs, of course, we know that a sell-off is where we create a new company. After creating a new company from an existing one. The shares of the new company that have been created are sold to third parties. So here, sell all shares of the new company to third parties. Basically, sell them out there publicly to third parties. And I gave you a very good example. So we have RCM here as the umbrella. So if, for example, we create a new company here called, for example, RCMB within RCM, and then we take this RCMB out of the current shareholders, we sell this RCMB to the public outside there, then that will be a sell-off. That will be a very good example of unbundling. Then we have, ladies and gentlemen, what we call spin-off. For those of you who have ever heard of DJing, spin-off, in this case, this RCMB will be spun, will be swinging around here. So it doesn't move out of this shell. It doesn't go away from RCM, the parent company. So it means that you create a new company, but this newly created company shares are sold to existing shareholders. So the shares and the spin-off, shares of the new company are sold to existing shareholders, like that. They are sold to existing who? Shareholders. Are you guys able to follow somehow? It is still part of unbundling. Because once you've been able to bring this thing as a separate unit. Of course, it will be having its own management, etc. Great that they are able to follow somehow. Then we have what we call a carve out. We have what we call a carve out. So under a carve out, normally what happens, if this is RCM now within RCM, what we shall do, we have created a new company, but now we don't sell all the shares. We shall carve out something for ourselves. And then we sell these other shares to third parties. So you're saying there very fast under a carve out, ladies and gentlemen, it's a form of unbundling. Where shares, where in this case here, a fraction of the shares of the newly formed company, are sold to third parties, and a carve out, the parent company retains majority of the shares of the newly created company. So we shall retain the controlling stake with the parent and the RCM. We shall own like 52%, 60%. We are only selling minority. Out there, we are selling minority. Out there, we are selling minority. Yeah, our best spin-off the DJ like that. And then, ladies and gentlemen, we have so many other forms of other forms of unbundling. For example, demerger. Opposite of what here? Merging. You had merged, like for example, we had CBA coming together with the NIC to form NCBA. Should they feel the heat of being together is too much, they can unbundle. They can do what we call demerger. So demerger is the opposite of merger, and a demerger, we normally have a breakup of a company to their old outfits. So we have now NCBA demerging to NIC and CBA to the old companies that they were. That's a form of what here? It's a form of unbundling. Then, ladies and gentlemen, we have what we call management buyouts. It's a form of unbundling as well. Management buyouts. So we have again, management buyout. So we have RCM example, and then we have RCMB. All right. So for management buyouts, ladies and gentlemen, for example, currently, I happen to be one of the directors of RCM. Of course, you can't be passionate about a business for so long. Even for me to have been at RCM for this time, I mean, I think I've tried. Because there are businesses we have tried in the past, and we just know that they weren't profitable. They were profitable, but you simply get tired of them. Like we tried a restaurant. When you keep on now going to a restaurant, you are selling whatever. I mean, you feel, this thing, when you're young, you think it's very nice. But as you age, you realize that whenever I'm getting profit, this is not my thing. Every day you are worried, these people are selling whatever they are. All right. But unless you're doing it on a very big scale, so you realize no. So the same case will happen in this case here, ladies and gentlemen, in some of these business we are doing. So after some time now, you will get in this case here, ladies and gentlemen, existing managers. So for example, at RCM, we have very, very many people. We have very, very many people who are existing, who are currently, for example, we have Mr. Job, CPA Job, right? So these existing managers here can easily see an opportunity at RCM. So then what they will do, they'll simply come and tell me, Mzee, now you're becoming old. Let's give you a very good pension alternative. Let's give you like 100 million, you just disappear. So in this case here, whenever we talk about management buyout, this is a situation where existing managers buy shares of a company. Existing managers buy shares of a company. The company has done some unbundling, and in this case here, the existing directors can't manage to run everything now. So then what happens under management buying out? They're buying out, so it is existing managers buying out existing directors. So whenever you're asked a question about MBO, management buyout, always remember that management buyout, it is existing managers who in this case here are able to buy shares of their company. If you just put it like that, you have all your marks. You have all your marks. Mzee enda nyumbani, yes. Mzee enda nyumbani. Mzee enda nyumbani. Bora wasikufukuze vibaya. Ukipatiwa kama 100 million, utaangalia nyuma. Ukipewa 100 million, utaangalia nyuma kweli? Ungekuwa kwa shoe zangu, utaangalia nyuma. Nikipeleka 100 million kwa government bond, sitakula vizuri sana. Kumaanisha kila mwaka nitakuwa napata more than 10 million. Kila mwaka kwa nahitaji pesa ngapi to be happy on this earth? I don't need a lot of money. I don't need a lot of money. My dear, but of course not today, because I still have a big dream for RCM. Not today, not today. Would want RCM one day, maybe before retiring, God willing, we should have like the true open university. You know, most open universities, I mean that, you know, like the one that you have in Kenya here. Yeah, the one that came the other day. Even most of these universities, honestly, in terms of online classes, I don't think they can match what we are doing. What we simply need is little exposure, and there we shall be. One day we shall be a very good example. I mean, we'll be the talk about in this town. That is why when we will be listing the company for shares, you guys should buy our shares in good time. In a good time. We should be among the first training institutions to list this company at the stock exchange. We are really, really working so hard towards that line. Then we have management buy-ins. So under management buy-ins, when I remember this management buy-in, I'm able to remember the 𝗢𝗖𝗂𝗏𝗲𝗏. So 𝗢𝗖𝗂𝗏𝗏𝗲, in this case here, we have RCMB. So these guys are very, very bright. They're able to scout and see that, I mean, we have a farm here with potential, but really struggling. A farm with potential, but really struggling. So in this case here, what do these guys do? What do these guys do? Under management buy-in, now we have experts, managers who are experts from out there. They can even come from outside the country. So in this case here, they scout and see there is this family. So basically, ladies and gentlemen, I would want you to appreciate that management buy-in, it is managers from outside who are walking in to the farm to come and help stabilize it, to come and help manage it. So outside managers buy our shares. They buy our shares. So like right now, we have this farm from India that is coming to be given rights at Kenya Airways, all right? And of course, our airport facilities to run this farm for us on our behalf for the next, say, 30 years. For the next 30 years. That's a very good example of a management buy-in. And trust you me, the moment those guys come on board like this, actually let them not even be just given like, you know, they want to give them like one section. If they take the entire airport, if they take the entire JKIA, I'm so sure that you'll never hear of those companies in this case here making what you're making losses. Because as Africans, ladies and gentlemen, inside here, what do we have? We are just greedy for nothing. You give somebody, in this case here, a small job, and then you hear that within 2 years, these guys have got 180 million. And yet the country, you know, if the country, for example, in terms of wealth was also growing like that, then but the country is doing like this, but you as an individual, you're going up. No, something is wrong. That is why we need, you know, even this concept of, I mean, having our colonizers being chased away. I'm among those people who believe that if we were still a colony, perhaps we would be better. That's debatable. But in terms of management buy-in, we have these expert managers from outside there coming to our organization. They buy shares, and then they do what here? Look at, for example, Safaricom. You know, Safaricom, it will not be what it is today. Safaricom used to be a department well within telecom. So in this case here, they were able to, at first, in this case here, they did a spin-off. So at first, in this case here, they created Safaricom as a different company, but in this case here, a public, not public, but Safaricom as a company, in this case here, under government, business enterprises. After that, what they do, they went and did the IPO. So the IPO, they sold virtually everything. They were left with very few, the government. They sold like 90%. So then that becomes what we call a sell-off. So within this sell-off, we had these Vodacom people. Is it Vodacom or Vodafone? Who are able to identify, in this case, its potential. So they walked in and they took over the management. That is why when they want to give us a CEO, even if it's somebody in this case here from our land here, Kikuyu land here, this guy was in Britain for so long. It's like just a Mzungu, right? They can't allow us in this case to just. So a very good example of management buy-in. Expert managers, they come to the organization, they buy the shares, and then they run the company efficiently. That's a management buy-in. That's a management buy-in. All right, ladies and gentlemen. And then we have the last one, which is a leveraged buyout. What is a leveraged buyout? Leveraged, from the word leveraged. From the word leveraged. Leveraged. From the word leveraged. Ladies and gentlemen, leverage means what we are geared. Leveraged means that you are using loans. You're using loans. So when we talk about a leveraged buyout, this could be a management buy-in, it could be a management buyout, but now the buyer doesn't have his own money. So the buyer, in this case, is coming to buy our shares with what we call debt. The buyer is coming to buy our shares with debt. And a leveraged buyout, I'm repeating here that the buyer, whether it's coming from inside here or whether it's coming from outside there, is coming to buy our company shares with a loan, And of course, the moment, ladies and gentlemen, in this case here, you buy a company with a loan, that is when you realize that you get the full meaning of the word geared. Because you'll be like geared. You will be, in this case here, having a lever, a gear. Yeah. So, you know, when you are leveraged, then automatically you are able to take advantage of so many opportunities. When you have a gear, you are able to move what you're able to move faster. There are people who hate loans. Like now, I know in this class, there must be people who don't like loans at all. But trust me, if you don't like loans, then automatically you're not be able to prosper. You can't prosper. You're supposed to be having loans all the way up to here. All the way up to here. We must work with loans. We must work with loans. We must work with loans. Is there somebody who does not have any loan? Is there anybody who doesn't have a loan? Do we have any ninja here that does not have any loan? Okay, Hassan, I can understand because Hassan is a Muslim. He's a Muslim. Muslims in this case here, they are quite keen on loans because, you know, even, tunafaa kuwa nayo. Company having a high gearing. So please don't forget that leveraged buyouts, because you can see on the papers, those concepts are really, really many. They're really, really many. Leveraged buyout, the buyer of our company comes in with what here? With a loan. And that is why we normally say that such individuals are a bootstrap. Bootstrap. When you hear of bootstrapping, a bootstrapped investor is that investor who makes investments using what here loans. Like myself, I'm a bootstrapped investor. Most of my investments in this case here are through what here? Through loans. That's why you can see I don't have the hair. Yeah, but I'm happy. Because when you're bootstrapped, like how soldiers strap their boots, you know, when you're bootstrapped, umefinywa. Una mahali pa kutokezea. Because you can imagine now you have bought a company using a loan. And then, of course, you being the new buyer of this company, you come into a company, in this case, that has already problems. So you're trying to solve problems with the company. Then we have lenders wanting back their money. So you are basically walking on a very tight rope. You are bootstrapped. Umefungiwa kwa boot katikati. So ukisikia bootstrapped is like leveraged buyout. Don't forget those terms. They're very, very important. They're very, very important. They're very, very important. They're very, very important. So Angelica is laughing at Mwalimu here. which is this man with loans, but we shall overcome. Chukua kwa sako. We shall overcome. So, ladies and gentlemen, are we together really up to there? Are we together up to there? Are we together? Are we together? Great, 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 great.